There is a company almost everyone is connected to, yet very few people can clearly explain what it does. It does not sell phones. It does not drill oil. It does not manufacture cars, software, or medicine. And yet, it is deeply embedded in nearly every one of those industries. This company manages trillions of dollars on behalf of others. Not millions, not billions, trillions. More money than the annual economic output of most nations on Earth. More capital than entire regions of the world combined. Its decisions quietly rippled through stock markets, bond markets, pension systems, and governments. This company is BlackRock. BlackRock is not a bank. It does not take deposits from ordinary customers, and it does not issue loans the way traditional banks do. Instead, it operates as an asset manager. Its role is to invest money for clients, pension funds, insurance companies, governments, sovereign wealth funds, corporations, universities, and everyday individuals saving for retirement. If you have a retirement account, a pension, or an index fund, there is a meaningful chance that BlackRock is involved somewhere in the chain. Not because it owns your money, but because it manages how that money is invested. That distinction matters. BlackRock does not claim legal ownership of most of the assets it manages, but it does exercise control, and control is often more influential than ownership itself. To understand why BlackRock matters, it helps to understand scale. As of the mid-2020s, BlackRock manages roughly $10 trillion in assets. That number alone is difficult to comprehend. It is larger than the GDP of nearly every country on Earth except the United States and China. It is greater than the combined economies of many advanced nations. It represents a significant fraction of total global investable capital. And BlackRock is not an outlier. Two other firms, Vanguard and State Street, operate on a similar model. Together, these three institutions manage more than $20 trillion. They are not competitors in the traditional sense. They all benefit from the same structural shift in global finance, the rise of passive investing. For most of the 20th century, investing was dominated by active management. Fund managers attempted to outperform the market by picking individual stocks. That model was expensive and often unsuccessful. Over time, data showed that most active managers failed to beat broad market averages after fees. This opened the door to index investing. Index funds do not try to outperform the market. They simply aim to replicate it. When you buy an index fund tied to the S&P 500, you are buying small pieces of the 500 largest publicly traded companies in the United States, weighted by size. The fund rises and falls with the overall market. Index funds are cheap, diversified, and simple. For individual investors, they make sense. Over decades, they tend to outperform most active strategies. As a result, trillions of dollars have flowed into them, and that flow has reshaped capitalism itself. Because index funds must hold shares in every major company. The firms that manage those funds inevitably become large shareholders everywhere, not majority owners, but consistent, permanent minority owners across nearly every sector of the economy: technology, energy, finance, healthcare, consumer goods, transportation, defense, media. BlackRock does not dominate one industry. It appears everywhere at once. This is what makes the modern structure different from historical monopolies. In the past, monopolies were concentrated and visible. A single company controlled oil, railroads, steel, or telecommunications. These monopolies could be identified, regulated, and eventually dismantled. But the new concentration is dispersed. It operates through ownership patterns rather than production. No single company controls prices directly. Instead, the same shareholders sit quietly behind competing firms across entire industries. This is not an accident. It is a consequence of how modern finance evolved. BlackRock was founded in the late 1980s by a group of financial professionals who were focused on risk. The founding insight was simple but powerful. Financial crises are often caused not by lack of capital, but by poor understanding of risk. From the beginning, BlackRock invested heavily in technology designed to analyze complex financial systems. Over time, this technology became one of its most important assets, not just for managing its own portfolios, but for advising others. As financial markets grew more interconnected, this risk management capability became increasingly valuable. Governments, pension funds, insurance companies, and central banks all needed tools to understand exposure across thousands of assets. BlackRock's systems offered that. At the same time, BlackRock expanded into exchange-traded funds, or ETFs. ETFs allowed investors to buy diversified portfolios instantly, at low cost, and trade them like stocks. This expansion brought BlackRock into direct contact with millions of retail investors, even though most of those investors never interacted with BlackRock directly. When you buy an ETF, you own a financial interest in its underlying assets, but you do not make decisions about those assets. You do not vote on corporate boards. You do not participate in governance. The fund manager does. This is where influence quietly accumulates. Every year, public companies hold shareholder votes. These votes decide who sits on boards, how executives are paid, whether companies merge, and how corporate policies evolve. In theory, shareholders control corporations. In practice, most individual shareholders do not vote. Participation is low. Information is complex. Many people are unaware these votes even exist. Institutional investors, however, always vote. Because BlackRock manages shares across thousands of companies, it casts votes at tens of thousands of shareholder meetings each year. No other private institution participates at this scale. This does not mean BlackRock dictates outcomes unilaterally, but it often represents the largest single voting bloc in the room. In close decisions, its vote can be decisive. Over time, companies notice this. Executives pay close attention to how large asset managers think. Corporate strategy increasingly accounts for the preferences of a small group of institutional shareholders, whose ownership is permanent, and whose capital cannot easily exit. This changes incentives. Traditional shareholders could sell their shares if they disagreed with management. Index funds cannot. They must hold companies as long as those companies remain in the index. Their influence comes not from selling, but from voting. This is a subtle but profound shift. It means power in capitalism is no longer exercised primarily through capital movement, but through governance. And this power is highly concentrated. One individual investor might own shares in a company, but a single asset manager may represent millions of such investors collectively and exercise the rights attached to those shares. That does not make the asset manager a villain. It makes it a structural actor. BlackRock often emphasizes that it acts as a fiduciary, obligated to act in the best interests of its clients. That is true, legally, but clients do not all share identical interests. Pension funds, governments, retirees, and individual savers all have different priorities. In practice, voting decisions are centralized. They are guided by internal frameworks, policy views, and long-term assessments of risk. These frameworks evolve over time. They reflect economic assumptions, regulatory expectations, and broader global trends. And because of scale, they shape outcomes. This is not a conspiracy. It is not hidden. It is the logical result of trillions of dollars being managed passively by a handful of firms. The question is not whether this concentration exists. It does. The question is what it means. In the next part, we will examine how this ownership structure affects competition, prices, innovation, and labor, and why economists increasingly argue that the greatest market power today does not belong to producers, but to shareholders who own everyone at once. Have you ever noticed something strange about the economy? In industries where you'd expect fierce competition to drive prices down, prices keep going up. Big companies that are supposed to be rivals act like they're perfectly comfortable with each other. Price wars are a thing of the past. Innovation seems to have slowed down. For a long time, economists blamed the usual suspects: companies merging, too much regulation, or globalization. But when they dug deeper, a new pattern appeared, one that our old rules weren't designed to catch. It turns out, the same small group of shareholders were showing up over and over again. Think about it. The major airlines, they share the same largest investors. Same for the big banks, pharmaceutical companies, energy firms. Even giant retail stores that compete for your business often have nearly identical ownership at the top. This phenomenon is called common ownership. Now, this isn't a single company taking over an entire industry. Instead, it means the largest shareholders in competing companies are the same big institutions, like massive investment funds. No single one of them owns a majority, but together, they are a powerful and constant presence across a whole sector. From a traditional perspective, this looks fine. Each company is technically independent. They set their own prices. There are no secret meetings or emails coordinating strategy. But here's the catch. It's all about incentives. If the same shareholders make money, no matter which company in an industry wins, the whole point of competition starts to fade. Winning isn't about crushing your rivals anymore. It's about keeping the entire industry profitable. And this changes how companies behave in very subtle ways. Company executives are often paid in stock. Their job is to keep shareholders happy. So, If your biggest shareholders also own your main competitors, are you really going to start an aggressive price war? That might help you gain a little market share, but it would hurt the overall profits of the sector, which in turn hurts the very shareholders you're supposed to be pleasing. The result is a kind of quiet understanding. Companies don't need to illegally collude. They just don't have a strong reason to fight. The airline industry is a perfect example. We all know flying is a competitive business. The product is basically the same, and we can easily compare prices online. Historically, airlines fought brutal price wars to win customers. But after the rise of these large institutional owners, something shifted. Airline ticket prices went up, even when fuel costs were going down and planes were getting more efficient. Studies that compared flight routes with high common ownership to routes with less ownership overlap found a clear pattern. Where ownership was concentrated, prices were higher and there were fewer new flights added. No one had to tell the airline executives what to do. The incentive structure had already changed their behavior for them. We see the same thing in banking. In theory, banks should compete hard for your savings by offering higher interest rates, and compete for borrowers by offering lower loan rates. But, in reality, the big banks often move in lockstep. Savings rates stay low, while fees seem to go up. Once again, the ownership overlaps are huge. When the same investors own big chunks of multiple major banks, the urgency to compete for customers just isn't there. If you move your money from one big bank to another, the shareholder doesn't lose. They own both banks. This doesn't require some evil plan. It's just the natural result of the incentives at play. The story repeats in the pharmaceutical industry. We often blame patents for high drug prices, but ownership plays a role too. The system favors stability over disruption. Even the tech world, which seems so fiercely competitive, isn't immune. While big tech firms compete on products, their major strategic decisions, like investments and acquisitions, are starting to look more and more similar. This reflects a shared shareholder base that prefers predictability and massive scale over risky, market-shaking innovation. This brings up a really tough question. If our markets are no longer driven by fierce rivalry, but by a kind of quiet coordination through shared owners, what happens to the core promise of capitalism? Capitalism is supposed to thrive on what we call creative destruction, the idea that bad companies fail, better ideas win, and competition fuels constant innovation. But when ownership is concentrated in the hands of a few powerful institutions, that destruction becomes very expensive. Why would you want to disrupt an industry that you already own? From the point of view of a diversified investment fund, competition inside one industry is a zero-sum game. One company's gain is another's loss. But stability and profitability across the entire industry, that's a huge win. This is why some people call common ownership a monopoly without a monopolist. There's no single bad guy to point to. There's no one person pulling the strings. But the outcome looks a lot like a monopoly. Higher prices for consumers, less output, slower wage growth, and less innovation. And workers feel this directly. In a competitive labor market, companies should be fighting to attract the best talent by offering higher wages and better benefits. But when the major employers in a region or an industry are all owned by the same big investors, the pressure to outbid each other for workers goes way down. Wage growth stagnates, and the bargaining power shifts away from employees. Studies have confirmed this, finding that industries with high common ownership tend to have lower wage growth than other sectors. Again, this isn't some conspiracy to hold wages down. It's just executives responding rationally to the incentives created by their ownership structure. Lower labor costs across the whole sector benefit the shareholders. So that's the direction things move. Meanwhile, consumers pay more, workers earn less, and small businesses face an uphill battle. They're not just competing against big corporations. They're competing against corporations backed by massive, stable pools of capital that give them an edge in everything from getting loans to influencing regulations. This just makes the big players even bigger, creating a feedback loop. The weirdest part: none of this is illegal. Our antitrust laws were written for a completely different time. They were designed to stop things like price-fixing agreements and obvious monopolies. They aren't equipped to handle this new world of dispersed ownership that leads to coordinated behavior. This is why common ownership is so controversial. Some economists think its effects are exaggerated, while others believe it's one of the biggest problems in our modern economy. But what's undeniable is that the very nature of economic power has changed. Power doesn't just come from owning factories or patents anymore. It comes from owning portfolios, and those portfolios are increasingly managed by a small number of institutions whose financial interests touch every corner of the economy. This doesn't mean they control everything. Markets are still unpredictable, and companies still fail. But it does mean that when big decisions are made about prices, wages, or strategy, they are made within a system shaped by a handful of giant, permanent shareholders. And that brings us to the next level. To manage ownership on this massive scale, you need more than just smart people. You need technology and data systems that can see risks and opportunities across the entire market at once. In our next video, we'll explore how financial technology, the concentration of data and government relationships are amplifying this new ownership structure, and what it all means for the future of our economy, our democracy, and our own financial choices. Thanks for watching, and be sure to subscribe for the next part of this investigation. As ownership concentrates, another form of power quietly expands alongside it. Modern financial markets are no longer driven solely by human judgment. They are shaped by data systems that analyze risk, correlations, and capital flows across thousands of assets in real time. The institutions that control these systems gain a unique vantage point, not over individual companies, but over the structure of the entire market itself. BlackRock invested heavily in this capability early on. What began as an internal risk management platform evolved into a system used by governments, pension funds, insurers, and financial institutions around the world. These systems do not merely record information, they model future scenarios. They estimate how markets might behave under stress. They recommend adjustments. When hundreds of large institutions rely on similar analytical frameworks, market behavior becomes synchronized. This synchronization matters. If many institutions respond to perceived risk in the same way at the same time, markets can move sharply, and suddenly, liquidity disappears, prices gap, feedback loops emerge. This is not theoretical. Financial history is filled with moments where shared models amplified volatility rather than containing it. The difference now is scale. When risk assessment becomes centralized, even indirectly, systemic vulnerability increases. The system becomes efficient, but fragile. Stable under normal conditions, sensitive under stress. This creates a paradox. The same institutions that provide stability in crises may also contribute to their intensity. Governments understand this. When markets seize up, policymakers turn to actors who have the infrastructure, expertise, and reach to act quickly. During financial emergencies, asset managers and central banks increasingly operate together, not because of conspiracy, but because of necessity. This relationship blurs boundaries. Private institutions execute public policy. Public authorities rely on private systems. Crisis responses depend on actors who are also market participants. This is not inherently corrupt, but it does raise questions about accountability. Who sets the rules when the referee is also on the field? The revolving door between finance and government deepens this ambiguity. Professionals move between regulatory agencies, treasuries, central banks, and asset management firms. Expertise flows both ways. So do assumptions. Over time, a shared worldview develops. Markets are stabilized. Systemic risk is managed. But structural concentration is rarely challenged, because it is the foundation upon which stability now rests. This creates a form of dependency. Breaking up large asset managers would disrupt markets. Altering voting structures would require redesigning retirement systems. Challenging common ownership would affect trillions in savings. The cost of reform appears high, so inertia prevails. Meanwhile, ownership structures become increasingly circular. Large asset managers are themselves owned by other asset managers. Funds hold shares in firms that manage funds that hold shares in them. The boundaries between owner and owned blur. This does not produce a single mastermind. It produces an ecosystem in which capital flows continuously. Ownership rarely changes hands, and governance is exercised quietly through standardized processes rather than dramatic interventions. In such a system, power is rarely visible. It does not announce itself. It is exercised through defaults, templates, and risk frameworks. This is why many people feel something has changed, even if they cannot articulate what it is. Markets still exist. Prices still move. Elections still happen. But decision-making feels distant. Influence feels abstract. Ownership feels symbolic. You may own shares, but you do not decide. This raises fundamental questions about democracy and capitalism. Capitalism promises choice through markets. Democracy promises accountability through representation. But when economic power concentrates in institutions that are neither elected nor easily regulated, both promises weaken. The system becomes efficient, but impersonal. It rewards scale. It penalizes disruption. It privileges stability over experimentation. None of this requires ill intent. The individuals working inside these institutions respond rationally to incentives. Investors choose low fees. Funds grow. Systems scale. Power accumulates. The outcome is emergent, not designed. And that makes it harder to confront. There is no villain to expose. No law clearly broken. No single lever to pull. So what happens next? One possibility is continuation. Passive investing continues to grow. Ownership concentration increases. Voting power centralizes further. Markets become more stable, but less dynamic. Returns favor incumbents. Inequality widens quietly. Another possibility is reform. Some policymakers propose separating voting rights from economic ownership. Others suggest limiting the percentage of an industry a single asset manager can influence. Still others argue for greater transparency and client-directed voting. Each proposal carries trade-offs. Reforms could reduce concentration but increase costs. They could empower investors but fragment governance. They could introduce instability into systems built for scale. The final possibility is disruption from outside the system. New technologies, new ownership models, new forms of capital allocation, changes that alter incentives rather than regulate outcomes. History suggests that systems rarely change from within. They change when external pressures make old structures unsustainable. For now, the system persists because it works, at least for those at the center of it. Markets function. Pensions are paid. Capital flows. But efficiency is not the same as fairness. Stability is not the same as freedom. The question is not whether large asset managers should exist. They solve real problems. They lower costs. They democratize access to markets. The question is whether any system should allow such concentrated influence over ownership, governance, and information without corresponding accountability. That question remains unresolved. And perhaps that is the defining tension of modern capitalism. Not a battle between markets and governments. Not a clash between socialism and free enterprise, but a quiet struggle over who truly owns the economy and what ownership means in a world where control is exercised through systems rather than deeds. The story of BlackRock is not the story of a single company. It is the story of how finance evolved, of how efficiency scaled faster than governance, of how ownership became abstract and power became indirect, and of how a structure built to serve investors slowly became one of the most influential forces shaping the global economy. Whether that force ultimately strengthens or weakens capitalism will depend not on intent, but on awareness, and on whether societies choose to redesign systems they no longer fully control. Once a structure becomes visible, it becomes debatable. And once it becomes debatable, change, however slow, becomes possible.